Ever heard of a bank that crowdsourced its fees? Or one that gave customers real voting rights on how the bank was run? That was Fidor Bank, a revolutionary German online bank that dared to be different. But what happened to this trailblazer in the financial world? The rise of Fidor Bank. Let's rewind to 2009. The financial crisis was still fresh, trust in traditional banks was shaky, and a new wave of fintech companies was emerging. Enter Fidor Bank, founded by the visionary Matthias Kroner. Their goal? To create a transparent, community-driven bank experience. Fidor was unlike anything people had seen before. They offered features like community-based fee structure. Customers voted on fees for specific services, creating a truly democratic pricing model. Social banking. Integrate your social media with your account, allowing for easy money transfers between friends. Real voting rights. Customers had a say in major decisions, from product development to strategic direction. These features resonated with a tech-savvy generation yearning for a more collaborative approach to banking. Fidor quickly gained a loyal following, becoming a symbol of innovation in the financial sector. UK expansion and acquisition. Fueled by their success, Fidor set their sights on the UK market in 2015. This was a bold move, hoping to replicate their German magic across the channel. While they garnered initial interest, uncertainty surrounding Brexit ultimately led to their UK exit in 2019. Back in Germany, things were seemingly going well. Then, in 2016, a surprising turn of events. Fidor Bank was acquired by French banking giant group BPCE. Many saw this as a perfect marriage, a traditional bank merging with a fintech pioneer. The dream deferred. Unfortunately, the dream partnership didn't quite materialize. Reports suggest a clash of cultures. Group BPCE, with its established ways, struggled to integrate Fidor's innovative approach. Fidor's community features and voting rights seemed to lose traction within the larger organization. The closure. Finally, in February 2023, the news broke Fidor Bank would be shutting down. Group BPCE cited strategic reasons for the closure. This sent shockwaves through the fintech world. Many saw it as a missed opportunity, a symbol of how established institutions can struggle to adapt to disruptive forces. Fidor's legacy. While Fidor Bank may be gone, its legacy lives on. They proved that a community-driven, transparent banking model could not only work but thrive. Their innovative features like social integration and voting rights continue to inspire fintech startups today. The impact. Fidor's story is a cautionary tale for traditional banks. Ignoring innovation and clinging to outdated models can leave them vulnerable. It's also a reminder for fintech companies. Maintaining their core values and navigating the complexities of larger partnerships are crucial for long-term success. The future of fintech. Fidor Bank may be a chapter closed, but the book of fintech is far from over. New startups are constantly emerging, pushing the boundaries of what banking can be. The future of finance lies in collaboration and finding a way to bridge the gap between traditional institutions and innovative fintech players. So, what happened to Fidor Bank? It's a story of ambition, innovation, and ultimately, a missed opportunity. But their legacy serves as a blueprint for a more collaborative and transparent future of finance. With that said, thanks for watching and until next time.